Welcome to This Explainer. Today, we're diving into something literally every trader faces, the hidden mechanical and emotional costs of chasing entries. Just a quick heads up before we get started, we're here to build up your disciplined process behaviors, right? Not to give out financial advice or trade signals. Let's get right into it. I want you to put yourself right back in that seat. You know the one. You're sitting at your desk, staring at the charts. You've done all your homework, you've marked your levels, and the setup you've literally been waiting for all morning finally appears. But then, maybe you get momentarily distracted, maybe you hesitate for a split second, or maybe the market just moves incredibly fast. The setup takes off, right before your eyes. And your order? Not filled. Have you ever been there? Have you ever watched a perfect trade completely leave the station without you on board? Man, it is just a universally frustrating experience. So let's break down the anatomy of what actually happens next. The candle surges upward or downward, if you're looking to short. For a split second, you just freeze. Your brain is scrambling to process that the plan you so carefully laid out is happening right now, but you aren't a part of it. And then comes that visceral pit-in-your-stomach moment of hesitation, which is rapidly followed by a total panic-induced reaction. You just throw your rules out the window, your lizard brain completely takes the wheel, and you furiously click buy, but you click it late. You're just desperate to get in at any cost. Look, we have all felt that exact sequence of events. It's a completely human survival reaction, just manifesting in a fast-moving market. Now let's objectively name what's happening here. Absolutely zero judgment or shame involved. It's FOMO. Good old fear of missing out. In trading terms, FOMO is that intense emotional urge to enter a position late, and it's driven entirely by the anxiety of missing a profitable move. It completely bypasses all your rational, carefully back-tested rules. At that exact moment, you are no longer trading your strategy. You are literally trading your anxiety. But here's the thing. Recognizing this definition is incredibly powerful, because once you name the mechanism, you actually strip away a lot of its power over you. This really perfectly illustrates the divide we're dealing with. In one corner, you have your valid plan. This is exactly where you want to live. It involves calculated risk, specific entry points, and completely calm execution. Honestly, it's kind of boring, but it's wildly effective. But in the opposite corner, taking over, is the emotional reaction. This is FOMO in action right here. Panic entry, hastily smashing that button, and worst of all, taking on completely undefined risk. Notice the stark night and day contrast between the structured plan you made before the market even opened and the chaotic reality of an emotional reaction once the market actually starts moving. So the big question is, how do we bridge that gap? Well, it starts right here. A disciplined trader pauses before reacting. The exact moment you feel that hot, urgent need to chase a surging candle, that physical response right in your chest, recognizing that emotion is your very first opportunity to intervene. You just pause. You don't beat yourself up for feeling the urge because, hey, the urge is natural. But instead of blindly clicking the mouse, you take a breath. You insert a momentary, highly intentional pause between the market's action and your reaction. Let's look at how this builds into the real mathematical consequences of our actions. We're shifting gears here from the pure emotion of FOMO to the cold, hard math of your trading account. Notice how a late, chased entry mathematically degrades your entire trade structure when you compare it to a planned entry. Your entry price? It's instantly worse. And because your entry price is worse, the distance to your logical stop loss has widened considerably. And what about your emotional state? It's gone from calm and calculated to incredibly anxious and stressed out. You haven't just entered a trade late, you've fundamentally ripped up the blueprint of the trade itself. Which brings us to our core thesis for today. Chasing isn't just some psychological hurdle you need to get over. It has direct, measurable impacts on your account balance. Let's look at these hidden costs. Risk expansion, worse location, loss of emotional stability, and poor execution quality. And here's the kicker. These don't just happen one at a time. When you chase, you are worsening your risk, your execution quality, and your emotional stability all at the exact same time. It's basically a cascading failure of your entire trading process, and it all stems from that single panicked click. Let's break these down a bit, starting with risk expansion. Guys, this is a massive hidden cost. Risk expansion is the unintended increase in your potential loss, and it's caused directly by entering a trade further away from your perfectly planned stop-loss level. Just think about it for a second. If your strategy dictates a stop-loss below a specific support level, and you enter 5 or 10 points higher than you planned simply because you chased the candle, well, your stop-loss logically still needs to be below that support level to be valid, right? So by entering late, you are automatically taking on a much larger financial risk than your original strategy called for.
You're risking way more capital for the exact same trade setup.
Furthermore, grabbing a worse location fundamentally breaks your math on the other end of the trade, too. A worse location means executing your trade at a disadvantageous price point. By getting in late, the market has already rapidly moved in your intended direction. And what does that mean? It means the distance to your profit target is now much, much shorter. So you've simultaneously increased your risk, like we just saw, and instantly reduced your potential profit margins. You are severely damaging the reward side of your risk-to-reward ratio. Basically, you're paying a premium just for the emotional comfort of feeling like you're in the trade. To combat this super destructive cycle, you really have to cultivate a new mindset, which we call missed trade acceptance. I absolutely love this phrase. It is the quiet, calm realization that not every market move belongs to you. Let me say that again. You are not entitled to catch every surge, every breakout, or every trend. The market is just an endless stream of opportunities. Accepting that you simply missed one and actually being perfectly okay with letting it go without you, that is a total superpower. It is the absolute ultimate antidote to the anxiety of FOMO. So, to help you put this philosophy into action, here is a practical step-by-step process rule you can use in your very next trading session. First, you identify your valid setup according to your strategy. Second, you clearly mark your ideal entry price. Now, here is the absolutely crucial addition. Step 3, you define a maximum acceptable chase distance. Ask yourself, how much slippage or late movement am I willing to accept while keeping the math favorable? And finally, step 4, if the price exceeds that defined distance, you abort the trade. Period. You walk away. You have established a hard boundary. And that brings us to the most crucial point of all. You must define that maximum acceptable chase before the trade ever appears. The key to this entire solution is premeditation. You have to establish this physical boundary while you are calm, rational, and sitting quietly in front of your charts. Do it long before the candle ever starts surging and triggering all that adrenaline. Because, let's be real, if you try to decide how far you're willing to chase while the market is actively running away from you, your emotions are always going to justify clicking that button. You've got to draw that line in the sand beforehand. As we wrap up these concepts, I just want to remind you that protecting your capital should always be your number one priority. And you do that by executing your edge methodically. The power to protect your account doesn't come from external signals or blindly hoping a late entry is just magically going to work out. No, it lies entirely in your own process and your ability to stick to the premeditated parameters you set when you were actually thinking clearly. I want to leave you with a final thought to take into your trading workspace. As you sit down for your next session, let this single reflection question be the ultimate filter for every single button you press. Right before you click buy or even immediately after you do, ask yourself honestly, did you enter because the setup was mathematically valid according to your plan? Or did you enter just to soothe your anxiety because the move was leaving without you? If you can't tell the difference between the two, well, the market will eventually charge you for the lesson. Thank you so much for joining me for this explainer. Stay disciplined out there, and I'll catch you next time.